Let's get right to our floor show right now. Joining me now with $4 trillion in assets under management is Goldman Sachs Asset Management Chief Investment Strategist at Innovator, Tim Urbanowicz. Tim, it's great to have you here.
Great to be with you, Cheryl.
Well, the tech onslaught continues. What did you make in particular of SpaceX and all this concern about CapEx spending across the board?
Well, Cheryl, I think it's very clear the market is done rewarding spending, and they want to see free cash flow. And we think this is going to continue to be a pretty big story and source of volatility really for the rest of the year. If you look at the big four, they've guided CapEx up to about $725 billion. And right now we're seeing basically a record gap between where these names are trading from a price to earnings standpoint and a price to free cash flow. So we need to see free cash flow. I think that's what the market is concerned about. And right now, from an investment perspective, we're talking to advisors about how do you diversify away from that AI trade, adding in sectors like financials, healthcare, consumer stocks that have had negative correlation to the AI momentum trade all year long.
Well, how do you do that then? You ask the question, answer it.
Yeah, I think that's a big piece of it is looking at those sectors
that have
diversified to those other sectors.
Yeah, is it healthcare? Is it financials?
I think those are a big piece of it, but also one of the biggest trends that we're seeing right now in the advisor and ETF market is a shift toward options-based strategies, things like defined outcome ETFs that are providing built-in risk management and really helping remove a lot of that uncertainty around free cash flow and the tech issue.
Yeah, because we've seen, that rotation we've talked about so much. We've seen that going into healthcare. We've seen some of that going into the financials, which, by the way, that sector had very strong numbers. Goldman Sachs, your company, one of those companies, but that did well and impressed the street. So do you reward them, pull some money out of AI? That certainly seems to be what is happening. But you say one of the things, this is interesting, one of the biggest mistakes you're seeing today, many advisors have positioned portfolios for only one type of market shock, a growth scare. Why is that a mistake, in your opinion?
Well, if you look at the issues that investors are facing today, we don't put that at the top of the list. The top of the list right now is inflation. Inflation that's stemming from this AI spending cycle, inflation that's stemming from this war in Iran. It's not necessarily growth. And if you look at the 60-40 portfolio, which so many advisors that we work with rely heavily on, it's very heavily dependent on long-duration fixed income, which does really well when growth pulls back. But in inflationary environments, that's not always the case. So again, adding in those strategies that we know are going to work with built-in risk management options, there's no guesswork, is really important. And then also, Cheryl, I think diversifying within that equity sleeve. And again, so much of the market is driven by AI momentum. How do we diversify away from that? That's really important as well.
Yeah, look, whether the economy, higher energy prices. I mean, right now we're seeing a big pullback in oil. One headline out of the Middle East changes that we're up another $10, $15. Again, I hope that doesn't happen, but obviously we're seeing a reprieve right now with the Middle East situation. But in general, you do see a lot of these portfolios, I'm assuming, that are just too overly weighted, and I'm assuming that's into AI. There's got to be more out there for investors, especially with Caterpillar's numbers.
It is. There's a lot more out there. We want to diversify. You look at the equal-weighted S&P 500 index, been doing very, very well. But, Cheryl, one of the things that we want to watch, I mean, we really view the rally we're in right now as an earnings-driven rally, which is exactly what you want to see. We saw valuations contract in the front half of the year. But, when we're looking at a lot of these AI names, most of the growth, in fact, you strip out AI names from the S&P 500, you're looking at earnings growth that's about half of what it is without it. And again, that all stems down from the hyperscaler spending. So the hyperscaler spending is not just about CapEx, it's about what trickles down as well.
Real quick before you go, Tim, how much do you factor in any Fed moves?
Well, I think the Fed is really important, and I think you have to prepare for higher interest rate volatility at this point. The communication style of the Fed, at this point, we don't even necessarily have a framework, Cheryl, for how investors need to think about what the Fed's next move is going to be. And investors love certainty. They don't like the unknowns, and we think that leads to more interest rate volatility. At the end of the day, though, we think that it's all about buying time while not losing credibility for Kevin Warsh.
Well, I think the bond market has a lot more say than the rest of us right now and what happens with that interest rates and what the Fed does. Tim, it's great to have you on the program.
Great to be with you, Cheryl.
All right.